I want to start with a quick thank you to the people at MetroStudy. Most of the data that I'm going to show you today, they helped me with, and I didn't want to give you the idea that I dreamed all this up myself. Let's start with a look at job creation. I have even more dated graphs than Brandy did. So this goes back to September with Houston at 66,000 jobs. That's been dated to about 80,000 jobs now. Houston's still leading the state. It's very respectable growth given the national economy, which has been very anemic. And look at population growth. As you can see from this chart, sometime in 2013, 2012 maybe, the Houston region's going to reach 6 million in population. It takes a lot of housing for 6 million people, and you can notice the trend in this graph. The long-term outlook for housing in the Houston region is very bullish. And I think that given the job growth that we're seeing, you're going to see beginning to see a real positive trend in housing in Houston. This next graph, Brandy touched on this, but back in the 80s, Houston lost population, and that's not happening now. So you're not going to see the complete devastation of the residential real estate market that occurred back then where we had boarded up subdivisions. That's just not happening now. It's not going to happen. They have problems like that in Las Vegas, but not here in Houston. Let's move on to the apartment market. The black lines are new deliveries. The blue lines are apartment absorptions. You can see that absorption has exceeded deliveries for a couple of years now. That's going to continue into 2012. There are about 7,000 units under construction right now in the Houston region that will be delivered sometime during 2012. But absorption will far outstrip that relatively small supply of new units. So we'll continue to see an increase in occupancy rates. Here you can see that occupancy has been gradually increasing over the last couple of years. That's expected to continue into 2012, given the tremendous employment growth that we're expecting in 2012. And I think that probably you'll see that trend into 2013 as well. Now there are about 14,000 units that are planned that are not yet under construction that will be delivered sometime after 2012, and so I'm a little reluctant to predict what's going to happen with occupancy beyond 2013. And these increases in occupancy have contributed to the increase in rental rates in apartments. You can see the average rental rate has been steadily increasing for the last few years, and that trend is also going to continue into 2012. And if you look at the occupancy by apartment class, you can see the highest occupancy is in the Class A and Class B units. And understandably, the new construction in apartments is in the Class A and Class B categories. And those units command rental rates that are well in excess of $1 a square foot. So as those units get added to the mix, you're going to see the average rental rate go up simply because those more expensive units are coming online. But you're also going to see increases in rental rates because as leases expire, the occupancy levels are going to allow the apartment owners to increase their rental rates on renewal of leases. Let's move on to the single family business. Mortgage rates are unbelievable. The 20-year average is 7%, and we're currently below 4%. I don't know that you can say a whole lot more about that. It's a pretty attractive situation from a mortgage rate standpoint. The only really kind of holdup in mortgage the business is that the underwriting has changed to the point that you have to have just a really high credit score. You have to have a big down payment. And a lot of the people that historically would have been in the market already with these kind of low rates are being held out because there's been something of an overreaction in the regulatory market about what you can qualify as a good mortgage. And the mortgage underwriters are just not willing to take the risk on anybody that's not just solid gold. So that's holding back activity level a little bit. And I think if we were to correct that segment of the mortgage business, we'd see a lot more housing activity. This next graph is very interesting. The scale on the left, the blue line, is the housing starts. The scale on the right is an inverted unemployment scale, and that's the red line. And you can see for the last 30 years or so, housing starts have been a very reliable leading indicator of where employment was going. That got out of whack in 2002 and 3, and we probably should have seen that as a red flag that something was wrong. We were all making a lot of money and didn't think about it too much then, but things corrected in 2007, 2008, and now you see that historical correlation returning, and you can see that housing starts have kind of flatlined at a fairly low level, and unemployment has turned flat at a fairly high level. And I think you're going to see housing starts continue to be relatively flat out into 2012 and 2013, and that would suggest that unemployment is going to stay relatively high through 2013, regardless of what happens in November of next year. I do want to remind everybody that if you look at this graph, you can see there's just a tremendous rapid drop-off in housing start activity. But housing is local. And this graph, I asked MetroStudy to look at what happened over the last 10 years in housing starts in Fort Bend County. And then I said, and let's narrow it down a little further, and what happened in the Katy Independent School District portion of Fort Bend County. And that's the red line there. And you can see that in Katy ISD, northern Fort Bend County, they did not experience the dramatic downturn in home building activity. It just didn't happen there. And in fact, in 2010, they started as many houses as were started back in 05 and 06 during the boom. So that housing recession, if you will, didn't happen in the northern part of Fort Bend County. One thing I should mention, you might have noticed that there's a little bit of a drop-off in 2010 and 2011 in the activity in that part of the city. That, I think, is attributable to a reduction in available lots, more so than any kind of softness in demand. And I'll get to the lot supply in a moment. Now, I don't want to suggest that everything is really rosy here in Houston, because we do have a lot of houses in inventory. The MLS, this is the multiple listing service months of supply, and you can see that we've got almost a 7-month supply of houses in the MLS, which is well above our equilibrium level. MetroStudy sets equilibrium in about 6 months. Our experience has been that we really don't get kind of seller strength until it gets down to about 5.5. But I think that this downward trend in months of supply is going to continue in 2012, so we're going to get back closer to equilibrium going into next year. And this shows a little bit of the effects of that excess supply in the MLS. The housing values have dropped a little bit here in Houston, a little less than 4%, and I don't think you're going to see that in 2012. That's going to moderate. We'll probably be at close to zero change in housing prices in 2012. I'm going to touch briefly on foreclosures. The media seems to have a fascination with foreclosures. If you look at Houston over the last 5 years, our actual foreclosure rate, which is that red line, has been fairly steady at about 1,000 units a month. And those 1,000 units are getting foreclosed or being sold. We're not building a big inventory of unsold foreclosed houses. Foreclosures in Houston are just not an issue. They have a problem in Vegas. We don't have it here. Looking at new home inventory. Here you can see the red line is new home starts, and the black line is closings. And you can see closings have exceeded starts for several years now. And that has kept new home inventories at very manageable levels. And you can see most recently those two lines have come together. And I think that's what you're going to see going out in 2012. The builder's going to be starting what they're selling. And this next graph is showing the reduction in inventory of finished new homes. And you can see that year over year, there's been a reduction at every price point. So the new home inventory is in good shape. The biggest reductions have been at the highest price points. So that's where the supply of new home inventories is the tightest. And looking at lot supply, I mentioned I'd talk about lot supply. You can see that here the lot absorption, the red line, has exceeded new lot deliveries by a fairly big margin for a few years now. And you're going to see that situation continue through to 2012. There will be more lot absorption than lot deliveries in 2012. So the lot supply is going to continue to dwindle, especially in the most popular parts of town. Now, if you look at months of supply of vacant developed lots, Houston is in better shape than almost any of the major markets in the country. You know, we have a lot of finished vacant lots out there, but we're in better shape than the other markets. I know this is kind of hard to read, but over on the far left-hand side is Atlanta, and it's followed by Chicago. Those cities have problems with lot supply. Now, if you look at months of supply by house price range, and the blue dots are the months of supply, you can see that the lowest months of supply is in the $300,000 to $500,000 house price category. That's particularly troublesome to me because Trendmaker's average home price is about $400,000. And in fact, if any of you are developing subdivisions for $400,000 homes, would you see me before you leave today? This next graph is probably the most accurate depiction of what the actual situation is with lot supply. If you look at the left, there's a big bar. Those are neighborhoods where there's less than 5 starts per year. I call those dead subdivisions. And a lot of that was lots that were put on the ground to feed the subprime market. They're in very inferior locations. The lot that was put on the ground doesn't fit the houses that we need to build today. Those lots are going to sit there for a while. There's a 15-year supply of lots in that category, and a lot of those are going to sit there for years before they're absorbed. But if you look at the other end of the graph, in those popular subdivisions where you're selling more than 72 houses a year, there's only about a 10-month supply of lots in that category. And if you consider the fact that it takes a year to year and a half to put new lots on the ground, 10 months of supply is a shortage. So in those popular parts of the city, like KDISD in Fort Bend County, there's just barely enough lots to keep the builders supplied. Move on to the National Association of Home Builders projections of housing starts nationwide. They're suggesting that we'll see about 500,000 starts nationwide next year. I think it probably will end up being a little bit less than that. And then they're showing a fairly significant increase in 2013. I should probably point out that last year I had the same graph, and they said that it was going to be up around 500,000 in 2011, and then we'd have a big increase in 2012. So they're kind of pushing that out as they see that it's just not coming as quickly as they anticipated. I think we probably will begin to see some steady upturns starting in 2013, but it's not going to be that dramatic, I don't think. And one last little brag for Texas. If you look at the house that sold for $200,000 in Texas, California, Florida, Nevada, Arizona back in 2000, and then look at that big bubble that the other states went through, and where we are today, that $200,000 house is worth more in Texas than in any of those big bubble markets. So we win. I got one more graph that I'm going to show you, and this is just to give you something to think about a little bit. Same graph, but I've added another line, and that is China. That might be a bubble. Thank you.